Chase, let's jump right into our first company. You want to talk about Union Pacific first?
Let's do it.
All right. So Union Pacific, a lot of railroad stuff going on. They're in the industry of railroads, only 1% short on it. 83% institutional owned. PE ratio, 19.5, above the industry at 18.9. Price to sales, 5.6 versus 2.4. That's expensive. Price to book value, 8.3 versus 17.6. That's good. Price to cash flow, 13.7 versus 11.4. That's okay. Nice PEG ratio, though, 2.4 versus 12.1. You want a low PEG ratio there. Now, over the last year, the earnings for Union Pacific, they were up 4.3%. Not as good as the industry growth, that's 10%. Sales for Union Pacific only up 0.4%, but the industry is only up 0.8%. The analysts do get a 5-year growth rate in the earnings of 8% above the industry at 5.7%. They do pay, talk about dividends, nice dividend, 2.5%. They only use 48% of their earnings to pay that out. Then the balance sheet, current ratio 0.7 versus 0.9. It's a little bit worrisome to me. And their debt's kind of high as well now, 2.1 versus 1.2. I know I helped this company years ago for years. Their balance sheet looked much better back then. I'm kind of disappointed here. Net profit margin is good at 27.8 versus 13.2. Wow, return to equity is 42 versus 17, and they got a lot of cash flow, free cash flow, $5.8 billion versus $2.4 billion for the industry. What do you got?
Well, it makes me wonder if the return on equity is that high. Generally, that can come from a lot of stock buybacks as you use that cash, and then all of a sudden it reduces the equity. But, it's kind of curious, I guess, on what their stock buybacks have been over the years. Current price for Union Pacific, though, it is $224.74. 52-week range, the low here, $204.66. The high, $258.07. I see year-to-date, the stock is down about 1.5%, so not much movement there for Union Pacific on the year. Going forward for the company, we go out to December 2026. The estimated earnings per share of $12.99 unfortunately gives us a target sell of just $215.63. And I was excited about this because the stock pulled back a little bit. They are now, I guess, in advanced talks to potentially acquire Norfolk Southern, another railroad company. And generally with those conversations, the acquiring company will get hit a little bit because of concerns over maybe integration costs, what debt would be needed. And with this company already having a weak balance sheet, I'd be definitely concerned.
Yeah, and I want to buy this company as well. It's a type that we like. I mean, AI is not going to change it. AI would only improve probably their operations. But again, it's like the market. It's expensive. And this is not how you make money investing, by paying up for these companies. It's a great business, but you said how much growth you get, like 10% or something from the target sell price?
No, it's above the...
Oh, but wait, the current price is above the target sell price. Oh, that's even worse. I thought.
And I think the concept of buying is interesting. I mean, right now Union Pacific has a dominant position in the western 2/3 of the U.S., and Norfolk Southern really focuses on the eastern states. Mm-hmm. So, I mean, that would be a way to kind of create this nationwide railroad. But then you have to have questions around regulatory approval. And there was actually a regulatory approval in 2023 for another merger between Canadian Pacific and Kansas City Southern. That created one from Canada to the United States to Mexico. So, I mean, it's definitely possible, but I don't think it's worth the regulatory risk. I don't think it's worth the balance sheet risk. And clearly the valuations don't look good either.
I guess we'd call this a sell.
Yeah.
Right.